What's the difference between a REIT and a real estate private equity fund? If you're like me and my wife and you were looking for passive income by investing in real estate without having to deal with toilets, tenants, and trash, the three terrible T's, right? You probably looked at REITs and you probably looked at like apartment syndication. But what's the difference? In a REIT or real estate investment trust, you're investing in a company that owns a portfolio of investment properties. But in a syndication or real estate private equity fund, you're actually investing in a single property. Two, in a REIT, you are buying shares of the company. In a syndication, you're buying actual shares of the property itself. So you actually have property ownership. Three, REITs are listed on the stock exchange, so they're a lot easier to find, but private equity real estate funds are actually private, right? Four, the investment minimums are lower on a REIT than a syndication. Syndication typically a little bit higher. Five is the liquidity. Your capital is a lot more liquid in a REIT. You can pull it out at any time. In an apartment syndication or a real estate private equity fund, that equity is held in the property. So it's a little bit harder to pull out on a whim's notice. Six is the depreciation. When investing in real estate, there's often more depreciation than there is cash flow. And so while you're taking a loss on paper, you are still making positive cash flow. In a REIT, you share in a lot less of the depreciation because you're investing in a company. Plus dividends are counted as capital gain. And then the last factor is the returns, right? That's what everybody wants to talk about. REITs on average over the last 40 years have returned an average of 12.8% per year, right? Which is actually pretty good. It's actually better than the stock exchange. Stock exchange over the last 40 years has been about 11.6%. But real estate syndications or real estate private equity funds that do real estate syndications, they're typically doing 15 to 20% per year. And that's partly because they're getting cash flow, they're getting tax deductions, and they're also getting a profit at sale. Where just something to think about. I hope that helps.